Now here is Ticky Fullerton on Your Money.
Hello there, I'm Ticky Fullerton, every night bringing you a full hour of the very best in business coverage across the nation and internationally, especially where business and politics meet. And it's Friday, so coming up, the best-loved coal miner in Australia, Whitehaven Coal half-yearly profits continue, so what's not good enough for the market? Our interview with CEO Paul Flynn coming right up. Healius has a plan and is on track, so says boss Dr. Malcolm Parmenter, who's not letting headwind from a weak flu season or private equity predators change his ambitions for the healthcare business. And a huge week of results from AMP, Telstra. Look, we've been following so many of them, but what does our market panel make of it all? CMC Markets' Michael McCarthy and National Stock Exchanges and Bowering are in the studio. Plus, we'll hear from fund manager Roddan Montgomery on his take on retail, brokers and the Royal Commission. Yes, well, now we have border security as front of mind in both Australia and the United States by the end of this week, having lost that historic vote on the floor of Parliament this week in the Medivac bill. Scott Morrison, the Minister for Boat Turnarounds, is relishing the idea of an election battle fought over hard borders. Donald Trump, meanwhile, has announced that he is going ahead with his wall come hell or high water and will use emergency powers to do so.
I don't want to see a shutdown. Shutdown would be a terrible thing. I think a point was made with the last shutdown. People realized how bad the border is, how unsafe the border is. And I think a lot of good points were made, but I don't want to see another one. There's no reason for it. And we're going to look at the legislation when it comes, and I'll make a determination then.
Well, Republican Ted Cruz has helpfully suggested that there's a solution in financing the border and it won't cost the taxpayers one dime. Let's build a wall, he says, and make El Chapo pay for it. El Chapo, of course, being the Mexican drug lord in jail in New York and charged this very week. The man who 3 years ago told Rolling Stone that he supplied more heroin, methamphetamine, cocaine and marijuana than anybody else in the world. Well, all of this is taking some heat off the tense US-China trade talks, with that March 1 deadline approaching, when Donald Trump is supposed to be ratcheting up tariffs again. At the same time, though, tensions are rising in the South China Sea, with F-35s the new weapon of choice. US strike fighters have been drilling in the region, and news this week that Britain, too, will be sending its last aircraft carrier to the South China Sea, graced with more F-35s. Trade and national security have always been linked, and we're now seeing parties take sides, with the Five Eyes countries, including the US and the UK, ever more cooperative. Here's Her Majesty's new Trade Commissioner for the region, Natalie Black.
The absolute linchpin of our relationship with Australia is around security cooperation, particularly through the Five Eyes partnership. That's a long-standing, enduring relationship. But what you're seeing with these announcements, particularly on the commercial side, is a commitment to growing jobs both in Australia and on the UK.
So it's boots on boats and boots in aircraft, if not boots on the ground. But cyber too, that's a changing world. It's hard to assess how much the banning of Huawei from 5G in Western countries around the world this year is about national security and how much is actually about the trade wars. The Americans, always the leader in tech, dropped the ball in the telco space, and Huawei picked it up. Well, I spoke this week to the Director of Technology at Darktrace, Andrew Sonchev, who gave us a very interesting, rather disturbing take on what might happen to the web.
It's one where it raises the possibility and the risk of cyber threat, but it's one where we probably can manage it if we do it carefully. It's part of the ongoing push for greater openness, greater interconnectivity, more sharing of data. And that's obviously a very good thing for consumers, and it drives innovation. So the opening of data between banking providers is potentially going to do wonderful things for fintech companies and help consumers with more competitive products. But the risk there obviously is that there's more data sharing and there's more openness and more access to your data.
China is still not giving an inch over the complaints that it's pressuring US tech companies for know-how and lifting their IP. The betting seems to be that Donald Trump will postpone his March deadline, perhaps by 60 days. He's already said he just might let that one slip. Well, let's go to domestic politics now, and a little bit of the Hayne Commission recommendations slipping through into Parliament. There's a new crackdown on excessive pension fund fees too, with the government passing legislation in the upper house Senate to reduce fees pension funds can charge on accounts with low balances. The deal struck with the Greens to pass it will see fees on accounts with $6,000 or less capped at 3%, with exit fees abolished. The Taxation Office will also now have greater powers to help people consolidate low balance and inactive accounts. The new legislation must now return to the lower house before it can become law. Separately, the Senate also passed laws to meet two recommendations from Hayne, which could see trustees and directors of funds face civil penalties for failing to act in the best interests of members. AMP has already responded to the move, saying it notes the passage of the bill and will work to assess financial implications of the revised bill. Well, for more on this, I'm pleased to welcome the Australian's Michael Roddan, who joins me live from Canberra. Michael, it's another extraordinary week down your way. Tell me about this change, first of all, on the pension side.
Yeah, it's a couple of quick, easy laws. Although this fee clampdown bill has been floating around for close to a year, it was first announced in the federal budget last year. And it covered a range of issues. So the 3% fee cap on small balance accounts, and then there was separate measures to consolidate lost and forgotten accounts, because about 1/3 of all superannuation accounts in the system are unintended multiples. And then there was a third part to the legislation, which was about making life insurance fees no longer automatic for people under the age of 25. Because obviously very few of them have any dependents or children. In the case of the battle over the legislation, it went through a long period of arguing over amendments. The government was reluctant to put it to a vote, and in the end, those insurance measures were just tossed aside in order for the government to get through the laws on the fee cap and the consolidation measures.
Oh, is that right?
So it's still. Yeah, so they've essentially claimed that they're going to have another go at the life insurance part of the bill, and this would generally save young people about $2.5 billion every year in pretty much largely unnecessary fees. But Labor was reticent to agree to it in full. They wanted to exempt workers in high-risk industries such as construction and the like. And the Greens just didn't want to see it go through at all, because they were worried that it could leave some vulnerable people uninsured, and they want Australia to have higher rates of life insurance coverage. So the government, go on.
I was going to say, and what's the coalition's view on this? Are they deeply cynical that these so-called sort of lower earning jobs are linked to, say, the CFMEU?
Yeah, so there's a lot of politicking about this, and it's very hard to get a proper read on it. One big problem with these life insurance fees is they do reduce your balance when you are young, when you're trying to amass that thing, and compound interest is the be-all and end-all of superannuation. If you don't have a big account when you're young, you're less likely to have a big account when you retire. Obviously, funds like CBUS, which is backed by the CFMEU, are quite concerned about the life insurance arrangements. They want to make sure that their workers aren't put at risk when they are on the work site. But it does sort of forget that a large portion of these life insurance claims are made by white-collar office workers. Things like mental health claims have soared in recent years. And there are a number of state-based work cover schemes that do sort of actually protect workers that do have injuries on the work site. These concerns are sort of dismissible if you consider that a lot of these superannuation life insurance claims are made for injuries that you get outside the workplace. But of course, Labor is going to listen to the industry fund sector. It's much closer to it. And the Greens amendments that the government actually did that just did away with the life insurance scheme, they were favoured by a couple of large industry funds, the CBUS in particular.
OK. Well, the government did get a couple of their bills through, though, didn't they, on those two Hayne recommendations? They would have been, you'd think, the top two of the 76 recommendations that they'd want to get through?
Yeah, and this was quite easy to do. It was just civil penalties weren't attached to these clauses. So basically, we saw during the Royal Commission, and it's been known about for a long time, super funds just do not act in the member's best interest. But if ASIC wanted to pursue it, or APRA for that matter, that had responsibility for the Superannuation Act, there are actually no penalties for when funds just fail to act in the member's best interest. This is attaching civil penalties to it, and then there's a further clause in that act about treating employers. So this is where funds might strike cosy deals in order to win lucrative contracts to manage worker wages. The government sort of called this like the Host Plus amendment, because during the Royal Commission we heard that Host Plus was taking a bunch of employer groups to the tennis every year at a cost of about $300,000 in order so they wouldn't move their funds away from Host Plus. But it's also going to affect everyone. You know, it's well known in the industry that a lot of large banks and wealth managers offer what we call bundled services. So if you kick over your superannuation savings, then you might get a better deal on a loan rate, or you might get some free accounting stuff. So it's rife across the industry.
So it might actually affect that sort of bundling. It goes well beyond entertainment.
Oh, for sure. I think that it's the definition of treating is quite broad, and bundling services is already illegal, but there are special deals and sort of cosy kickbacks that are rife in all parts of the sector, not just when you go to the tennis or corporate sporting events.
Michael Roddan, it's really great to get your take on this. Quite a tricky little area, and obviously it's going through into law now, so thanks very much.
Thanks, Ticky.
OK, well, let's go to some results now. Now, Whitehaven Coal's half-year results. I've said they're the best-loved coal miner in Australia. Perhaps they're the least hated, actually, at the moment. Anyway, they've cut their full-year production guidance, despite profit rising 19% thanks to higher prices for coal and the coal it sells across Asia. Coal prices have been on the rise amid strong demand, particularly from China, outpaced supplies, which have faced setbacks, including weather disruptions. Production, though, was steady on the year earlier, and sales a bit weaker. Investors are set to get a special dividend of 5 cents a share on top of the interim dividend of 15 cents a share. Well, for more on these results, pleased to welcome the CEO himself, Paul Flynn. Great to have you in the studio again. Thank you
for having me.
Now, look, shares are down. I mean, they went down almost 10%, and they've come back a little bit. Now, is this is obviously because brokers really thought you were going to do an awful lot better, maybe 30%. You've missed by 30%. Do you think that was just those great production numbers in January? What do you think caused the mismatch?
Ticky, it's hard to rationalise and pull it apart exactly what's at work there. I mean, the backdrop was obviously coal prices dropping overnight, so the market was primed for some downward movement today.
Yes.
We've trimmed our guidance, as you say, for the year, about 5% lower than what it was previously. But we've posted record results at pretty much every level, at revenue, at EBITDA and at NPAT.
Yes.
And a very substantial return to shareholders that we've...
So Maules Creek going like gangbusters, Narrabri?
Yep.
Yeah.
Yeah, Narrabri is the one where we've trimmed our guidance and had a very good last quarter.
Yes.
But since the quarter we've had a few waiting events there which has slowed progress down. So we've trimmed that guidance as a result.
And production coming back in the second half?
You'll have a bigger second half. Yeah, you'll have a bigger second half, as we've traditionally done, I suppose, between the first and second. So we're expecting a good half.
And what about your costs? Because I think they're ticking up a little bit. Is that right? Am I right?
That's right. We gave guidance at the time of the quarterly report that our guidance would need to be lifted to $67 for the full year. So the first half has been challenging in the sense that, as I say, less coal from Narrabri than what we'd like. That's our cheapest coal. When you have less of that, your average cost rises as a result.
Yeah. And sales volumes overall?
Very good. Yeah, sales volumes have been strong, so we've had good stocks to be able to sell even whilst production has been slightly lower. So we've drawn down our stocks and converted that in at good prices.
And what about the outlook? Tell us about them a little bit about the markets.
market's strong. Underlying demand is excellent, so we can sell everything we've got. That's more's the shame, I suppose, that we don't have a few more tonnes from Narrabri, given that the market really appreciates the quality we've got.
Now, let me go to this extraordinary court case that we've just seen come through at the Rocky Hill, I think it is called, where the judge... Well, just explain what the judge actually decided.
Well, it's an interesting dynamic, this one, because this is a project which is unsurprisingly had some challenges. It was the government, the Department of Planning, recommended against its approval in the first instance, and the Planning Assessment Commission also echoed that view. So it's had two difficult positions.
But it was knocked back for a completely different reason.
Well, and
the judge reasoning...
Amenity reasons, yeah. So amenity, there's a community not far away from it, so Planning Assessment Commission and the Department of Planning before that have both recognised that and said this has some challenges, we don't recommend it.
Yes. But more broadly, and I suppose what's really significant for the industry, is that he, as I understand it, really said that this should be knocked back because it contributes greenhouse gas, and furthermore, that greenhouse gas contributes to our meeting Paris. And therefore, you know, you've got one mine there, and the rationale for it really being an environmental, greenhouse gas issue.
Well, I think this the judgment is completely out of step with the way the government has administered approvals for projects in the past and how they've considered emissions. So there's one thing about our obligations from a Paris perspective, but it's a totally separate matter to be talking about somebody else's emissions. Which is
so this coal, is this
export?
Coal? Yes,
coal.
It's export, but it's export for steel, or is it export for thermal?
Well, steel, one and the same. You use coal that gives off emissions, one and the same. But this is
but it's not even for heating. Actually, no. It's actually for making cars, which most people believe we still need to go on and do.
Most people would have that view still.
Yes. So this is actually
even
metallurgical coal. Yeah. And what sort of impact do you think it might have across the industry and indeed beyond?
Well, it's too early to say, I think, because in our instance we have our approved Vickery project that we're seeking approval in a large form.
Yeah.
It's within the IPC format. It doesn't go to the Land and Environment Court, as this one did.
Yes.
That's under a different system. So
could it, though, be... I mean, is there a risk that some of your projects get referred to the Land and Environment?
No. The notion that the merits appeal, which this was based on, is extinguished by going through the IPC process. Right.
So you're not at risk as far as your investors are concerned?
That's correct. Yeah. That's correct.
What about other projects across Australia?
Well, I think this, as I said earlier, this probably has some broad ramifications that need to be considered, given that any project of any stripes, whether it be coal or otherwise, that has...
You even think Badgerys Creek could be caught into this?
It has an emissions footprint, a large one. So one interpretation, you could say that that's exposed to this judgment.
Yeah.
It's an extraordinary thing, I think. Here you look at it and it says the judgment evidences and supports the lack of a recommendation in these two previous forums by DPE and then also the PAC. Yeah. And so supports that for amenity reasons, but then takes this, what seems like a gratuitous opportunity to bundle every other case that EDO has lost in the past, and here's my opportunity to bundle that into the back of this judgment and try and cement that into our public psyche about how we should be thinking about our important emissions reductions obligations.
How do you think the coal sector, I mean, called you the least sort of hated of the coal sector? Because it's, I mean, there is such a sort of front now trying to end coal mining in Australia. Where do you think investors, how do you think investors should look at this now?
Oh, I just think it's another opportunity for someone to throw a few stones, and that's, we shouldn't get too excited about it. I mean, the other side, the naysayers, will love to whip themselves into a frenzy about this type of stuff. Yeah. As I said, it doesn't, our process with the Vickery project is unaffected by this.
Yes.
And so I think we've just got to have a cool, calm look at it. It's contrary to the way the government regulates this area. So this court has gone against everything that the government has done in presiding over the approval of projects in the past. Yes. The government will need to cure this.
The government, so we'll need legislation to sort this out?
I believe so.
Do you think the Labor government has the ticker to do that?
The state government.
If this is a state-based thing, of course it is, sorry. So do you think the Berejiklian government, or indeed whatever government comes in March, would have the ticker to do that?
Well, I think it's an interesting notion that a New South Wales government would attempt to usurp the national authority of our government, of whatever colour you care to name. Their responsibility is to manage our emissions reductions obligations, not a court in New South Wales.
And indeed, I mean, how important is the coal sector to the state government?
Well, we're the largest single exporter, as you know, in the state, and coal is the largest export in the country at the moment, having surpassed iron ore. So, and good people in Asia rely on our very high quality coal to reduce their own emissions. And so the point that I made earlier is that it's tantamount to those who sell us crude oil saying you've got too many cars per capita in Australia, and therefore I'm going to stop selling you crude oil so that you don't contribute to climate change any further. All
right, well, let's pull it back to your own results and your outlook now. What's your message for investors?
Look, we've got a great outlook. The business is doing well. OK, costs have come up a little bit. That will moderate as we've guided those costs in the full year will come down. That's right.
Okay.
So that's good. We've got 2 great projects in the pipeline that we're looking to build. So Vickery going through the hoops as we described. Our Winchester South project, very exciting in Queensland in the centre of the Bowen Basin. Making good progress.
Dividends going forward?
Dividends have been very strong, and we've been very clear with our shareholders that in the absence of something productive to deploy the capital to, we're generating a lot of cash, as you know, the money is coming back to our supportive shareholders. And today was a very good example of that. We've earned 30 cents a share, if you like, in the first half. We've returned 20 cents of it, so 67% of it in the first half. So that's very strong.
Have you had a chance to talk to any investors or brokers?
Yes,
And what's their response been?
Well, I think they're cautious about the production downfall by 5%. But I think that's a point in time observation, and I think that will be recovered pretty quickly. So I think everybody sees the company as very unique in having a growth profile like pretty much no other resources company in the country. So I think that's very exciting, and we just need to execute through the approvals process and getting these projects up and running.
Paul Flynn, so good to have you in. Thank you very much.
Thank you again.
All right, well, now, after the break, Healius CEO, Dr. Malcolm Parmenter, that's the old Primary Health, on his half-year results.
You're watching Ticky on Your Money.
Healius, spelled H-E-A-L, Healius, formerly known as Primary Healthcare, has trimmed its full-year guidance. It now expects underlying profit for the full year to top out at $98 million, down from an earlier forecast of $100 million or above. So just a slight miss there. But the company says the first half result has been below the normal run rate, with soft market conditions experienced in all divisions amid a benign winter flu season. However, it does expect underlying market conditions to improve in the second half. Shareholders will be paid a near 4-cent interim dividend. Well, for more on these results, I spoke with CEO of Healius, Dr. Malcolm Parmenter, a little earlier. Dr. Malcolm Parmenter, very nice to talk to you again, and the first time as Healius. How's the brand going down?
Yes, well, it's a new brand and a new name for us. So it's been something that's been coming for a long time, and it's really been the sort of culmination of changes to our culture, to the way we are as a company. You know, we've been much more than a primary care deliverer for a long time. We have pathology and we have specialists and we have day hospitals. So
very, very importantly, I mean, you came in as a reformer, and I'll ask you about the changes to all the various segments. But it has, your first half, you've had a few headwinds, and not least that the flu season hasn't been bad enough for you, really.
Well, yes, I'm sure the flu season not being so strong has been good for everybody else, but not so much when you're in healthcare. Yeah, look, the first half was really about, I think, our pathology business in mostly. I think we had a number of headwinds that were impacting our pathology business. So a lot of them were locked in before I started here, really. You know, we'd lost the bowel screening contract, a national bowel screening contract. We had some issues with the Dorevitch business in Victoria. So,
but you think the second half is going to be better within pathology? I mean, even though January was quite weak, now why do you think it's going to be a better second half?
Yeah, well, look, historically, the business has largely traded better in the second half than the first half. So there's quite a long history of that happening. It's kind of how the months fall a little bit, I think, is part of that. But yeah, typically trades better. I think, you know, the lower volume was, yes, about the flu season. That was certainly part of it. There were some compliance things that were happening last year that we don't expect around Medicare, that we don't really expect to be repeated in this next period.
And your productivity is pushing forward. Your reforms on that front are going up.
Yeah, so we've got a number of initiatives in that will deliver some benefits in productivity in the second half.
Okay, now look, let's go to your GPs. You're on this drive to reform how your GP services are, how you engage with your GPs. They're getting younger, but more have left. Older GPs largely, than you've managed to get in. Is that a concern?
Well, we still had more coming in than leaving over that period to January. But
more than you expected left.
More than we expected, yes. So we had a number of retirements early in that first quarter. That's now stabilised, and we've put a fair bit of effort into that retention component as well. We are a medical centre business in transition, so there's a lot of work going into how we deliver services to our partner GPs and making that a better place for them to work with new technology, new property refits and changes to design and new technology that...
And you're buying, in some cases you're buying whole practices, which is not cheap, of course.
Our Health & Co business has been buying whole practices. Within our Healius Medical Centre, our large-scale medical centre business, we have been buying some smaller practices that are located nearby to merge those into our existing business. And that's where we have space for those practices, and we don't have the patient volume to just recruit a GP without a patient base.
And once again, in this segment, you see a better half next half, and in terms of getting more GPs on, what about the costs and the demand for upfront payment? Is it going to be more their market than yours, I'm wondering?
Look, I think the recruitment's been growing quite strongly, and the vast bulk of those are coming on with no upfront payments and not a percentage disbursement. So, look, the number that take upfront payments varies up and down. From a quarter, it was 20% or 24% in this half. In the previous half, it was 6%. So it does vary a bit in terms of where they go. So the actual size of the upfront payment is probably smaller in this last half as well, though.
Now, something else happened in this last half, of course, which is that various people have been circling around Healius, your Chinese shareholder, of course, but and the board has knocked that back. I think the price was too low for him. Now there are rumours of other private equity players coming around. Has that changed or impacted the operations at all? Because obviously you're trying to get doctors to come on board, aren't you?
Yeah, look, I think from a GP recruitment perspective, recruitment's growing quite strongly, and we're not hearing that from any of the GPs who are thinking about coming on board, that a change of ownership could conceivably be a barrier to that. Where it does have some impact is in where you're buying a practice to backfill, because that's quite a long process, and there are some concerns in that space maybe, but still quite strong in that area as people look to do that. So, look, you might think that would happen, but we're not seeing it.
And the board obviously made that decision, and you're comfortable that you can deliver for shareholders the value that the board clearly feels that there is in this business going forward.
Look, we've put a plan to shareholders. They've backed that with quite a bit of money in the capital raise last year. And we're committed to that. And I think what you'll see from our presentations for the half-year result is that we are making progress on each of those. You know, we're making progress in medical centres. We'll have 15 of our medical centre properties upgraded by June 30 this year. Our technology is out to the majority of our medical centres now, and our recruitment's moving along. In pathology, we've signed our contract for our laboratory information system. Our serum work area is well underway imaging, our technology refresh.
And that's been quite strong imaging, hasn't it?
It has been quite strong, yes.
Okay, if a private entity was to come in and take over, presumably it would be a very different game. But what would you like to think that any new owner, what sort of vision would you like it to have, I suppose?
Well, we'd like any owner to clearly care about culture, because that's important to us here. And look, the future direction of the company. But look, my belief is that we would absolutely get that, probably. You know, we
that endorse the strategy.
That would endorse the strategy. I mean, the strategy is starting to show signs that it will work. We have a lot of confidence in it here that it will work. You know, I think the reason somebody would want to buy the company would be because
it's on the right track.
It's on the right track.
So, and I haven't asked you actually about some of your new areas, like or areas that you're building, like dental and IVF. How significant do you think they're going to become in terms of contributing to the bottom line?
Look, dental is a business that is located within our medical centres. We don't have a plan to take that outside of our medical centres to look at acquiring dental elsewhere. But we do have within our cap raise plan last year another 42 chairs that are going into places where we know there's demand for it. So we will continue to grow it. Day hospitals is the area where I think there is real opportunity in that space. And we've obviously made an investment there. We're looking at other opportunities for investment in that space. The day hospital business that we've acquired has a particular model that is looking to bring some of the surgeries that you would normally associate with long stay hospitals into the ambulatory surgical
and you like that model?
Sphere. Like that model, it's become very prevalent overseas, and I think it is the future here as well.
Finally, can I ask you about politics? Because there's a good chance that Labor will get in. We've got the MBS review happening. Are there any issues that are on the sort of that investors should be thinking about, be concerned about at all?
Look, I'd certainly like to see more support for primary care. I think primary care has a lot to offer in terms of what it can deliver for the health system. I think we've seen some recommendations from the MBS review. We haven't seen any funding allocated to that at this point. Well,
you can see the lobby group of GPs very much pushing for that. Are you hopeful?
Well, look, I think general practice has been, you know, probably underfunded, and it's certainly had a freeze for some time, and that is hurting in general practice.
Well, let's hope something comes from it and they can compete with each other on that. Wouldn't that be nice? Dr. Malcolm Parmenter, thank you very much for joining us.
Thank you, Ticky.
After the break, our markets are wrapped for this very busy and heavy results week. Michael McCarthy from CMC Markets and Bowering, Managing Director of the National Stock Exchange, will join me next.
This is Ticky on Your Money, covering the big business story.
Yes, welcome back, and moving to markets now. A huge week for the reporting season. Let's get across a lot of these major moves. I'm joined now for my weekly market panel with Michael McCarthy from CMC Markets and Anne Bowering from the National Stock Exchange. Guys, thank you very much for coming in. Where should we start? Telstra, Anne, what do we think? We just bat on, do we? Ears pinned back, Andy Penn.
Look, you know, there were some positive signs there. Obviously, technology is at the forefront of many strategies at the moment. However, putting that aside, I think really this is what we're looking at is what was a highly regulated monopoly environment finally facing the brunt of competition, and that's coming down to roost with changes.
So that's all the pressure coming back onto the business itself.
Yeah, which is you know, fantastic for customers. We're getting some better outcomes through competition,
but not necessarily shareholders going forward. Right. Okay, Michael, do you agree or disagree?
I agree certainly with the long-term view, but it's clear that the market is having an argument about this one, Ticky, because since the result, the stock was at 322 pre-result.
Yes.
Since then, it has gyrated a number of times between a range between 307 and 323. So on balance, they're saying negative. It's a question of how negative.
So where do you sit? You're not shorting the stock, are you?
Absolutely. I went short before the result, and I took, through derivatives, I took exposure to the dividend. I shorted the dividend. Unfortunately, the professional option traders had also lowered their expectations interest as well.
So do we think that there's any chance that, say, if Labour got in May, that they would actually write down the value of NBN and give Andy Penn what he thinks, what he wants, which is a bit more margin?
Oh, look, I think that I personally don't think that's particularly likely. I think that that they would be looking to realise the value there medium term rather than taking write-offs at this point in time. Yeah, yeah. So really, you just have to believe in 5G and that somehow this is going to...
Well, that's exactly it, Ticky. Yeah. Remaining as a shareholder in Telstra at the moment is a matter of faith, and I prefer not to invest on that principle.
All right. What about your faith in AMP?
Or the lack thereof. When it comes to AMP, I'm an atheist.
But surely, well, if you're an atheist, I'm not going to talk to you anymore. And surely we have seen the worst, haven't we? We've surely hit the bottom with AMP. I mean, if you are going to believe in AMP, it has a future, you'd be buying now, wouldn't you? They
have more than one string in their bow. So obviously we're looking at the sale going through of the life business, which will release some capital for them. There's some decisions there to be had on what they do with that. But, you know, speculation around the table is, are there other assets or businesses where they'd be looking to make a divestment and realise some more cash from those
Could they be a target still?
Oh, look... I would have to, you know, with the opportunities to realise cash, yes, I think that makes you reasonably attractive. It's all about price, isn't it?
Of course it is. Now, Michael, you just don't like them, even under new management.
I'd love to buy them. They've fallen so far. This is exactly the sort of share price I like to get involved at. But the problem for me here is the numbers are terrible. Fixing this problem is going to take at least 2 years.
What about the new fellow? Have you got confidence in him?
When I hear a CEO who's come in after all of this, which, you know, fresh pair of eyes, hands was definitely needed, hear him say a results presentation that is terrible after AMP has basically been dacked in public, that this is a great business with a noble cause, I was revolted. And the market...
Really? Well, I mean, they've got to start from somewhere, and they have that brand and history. And, you know, when they originally started, when was it, 100 years ago or whatever it was, I mean, they literally came in. It was in insurance, actually.
A bit of humility would be a good start, Ticky. A bit of fessing up and talking about the cultural change that's required. They need radical
So they haven't done enough. They're Ken Henry to you.
And they haven't dealt with... Well, yes, but yes, they do take out the Tone Deaf Award for the week, but they also haven't dealt with the key structural problem. There's no doubt in my mind that the future of finance will see a separation of the provision of financial products from the giving of advice.
But
and they haven't dealt with that issue.
Hayne did not touch vertical integration.
But
that was...
Who will be implementing Hayne? That's one of the key questions. And if it is the current opposition, I suspect they will go further than Mr Hayne has recommended.
All right, all right. Well, let's talk about a market darling then, and CSL. Now, how did that business go? I mean, it cannot just outdo itself, as I was saying to Paul Perot. It just, you know, it's just got... The expectations are so high every half year, aren't they?
Yeah, look, but they for all intents and purposes met expectations this half year and look to keep going in that direction. They've got strong demand for their products. They are working on expanding their distribution, so with more centres, more collection centres to help meet that demand through supply. So, you know, there's some really...
So when's the opportunity to buy? When there's some minor glitch and the market goes, and then you just go in and buy and give it all to your grandson?
Yes, that would be a very fortunate grandson.
I'm a little cautious. I love CSL. I think it's a great Australian success story. I think, looking over the last 3 decades, it's the best company listed on the Australian exchange. But there are issues here, and even after the pullback we've seen today, we're still talking about a multiple in the 30s. Now,
it was much higher.
Oh, absolutely. It's been close to 40. And, of course, it touched $232, right, whereas we're talking about $185 today. But when I look at those charts, I'm seeing support post the result, 184.50, 185, 185. If it breaks that, it will gather downside momentum. Great quality business. I agree it'd be an opportunity to get in. But when a stock like this, which is loved, turns sour, it can fall a lot further than people expect. Long term, be happy to hold it. But short term,
All right. Now what about JB Hi-Fi in this sort of retail market?
There's another great arm wrestle going on. The fourth most shorted stock on the market delivers growth.
They got their fingers burnt, didn't they, a little bit, though, those shorters?
Oh, yeah. Oh, well, everybody got a lesson. The stock immediately post-result rallied 7% and then gave up 5.5% of that. So it's game on in this stock, but they delivered 4% revenue growth and 5% profit growth.
How do they do that in this sort of market?
Well, with good management. They sat back and they looked at their product mix and they looked at where their high margin products were, and they've concentrated and focused their business growth on that, and they've managed their costs. So they're also looking forward to how they're going to compete with the likes of Amazon and trying to think a bit laterally how to differentiate themselves to really drive home their value proposition, which is that face-to-face sales environment.
All right, well, let me end on one from today. Medibank. Yeah, that was interesting, wasn't it?
It certainly was. They grew subscribers, grew members, however you want to term it, in a very tough environment. And the share price rallied. It was.
And Craig Drummond saying, bring it on, this cap on the Medicare premium, because we'll just pick up all the little ones that can't cope, you know. It's quite interesting, wasn't it?
Yes, yeah. Well, I mean, this is the thing with regulated businesses that we're touching before. There's quite a, there's a challenge there in being able to manage it, but makes the opportunity around the edges.
Craig Drummond going to be CEO of NAB, do you think?
Don't think so.
Right.
I still would have Mike Baird in prime position. Odds-on favourite.
Would you know? Right, OK. Well, we will watch. Michael McCarthy and Bowering, thank you very much.
Thank you.
OK, well, after the break, we'll get across what's driving recent market moves. Roger Montgomery from Montgomery Investment Management next. Yes, welcome back. Let's talk a little bit to begin with about retail. We've just been talking about how JB Hi-Fi has kind of bucked the trend, but generally the last few months of retail have been shocking for so many retailers. Now, there may be actually another story behind why that is occurring. I spoke with Roger Montgomery from Montgomery Investment Management a short time ago. Roger Montgomery, we haven't spoken for a little while. Now, you see a real thematic pushing through this year.
Indeed. So what we've seen is in the retail stocks, we've seen good results up to the end of December, but a deceleration in December itself, so November and December. So
it's been a disaster for some retail stocks.
The second quarter of the first half, what we've seen is a deceleration in growth and a rapid deceleration. That's continued into January. So we saw that, for example, Nick Scali made those sort of comments, JB Hi-Fi, similar comments. I'm not surprised by any of that. We did know that the economy was slowing down, particularly at the consumer sector. The economy was slowing down at a rapid rate of knots, and it was only a matter of time before the RBA had to lower
We've got the
their growth
Phil
expectations.
Right.
So they lowered their expectations from 3.25% to 2.75%. And we also know that we saw foot traffic absolutely decimated in December, down 8% year on year in December.
What's this saying about the consumer?
Well, the consumer's pulling back. So why is the consumer pulling back? That's the big question. Now, everyone's pointing to all sorts of things. Uncertainty about the election. They're talking about wobbles in China, trade tariffs and all that sort of stuff. Really, it's much simpler than that. We've actually entered what I'm going to call the Great Australian Deleveraging. So we've gone from the GFC to the GAD, and it's only just begun.
And right at the level of the individual.
Right at that's where it's starting. That's really the nub. It really is the core of what's going on. People are simply pulling back. Now, why is that happening? It's pretty simple. We've seen massive declines in property prices. The Australian led the paper today with stories of suburbs like Box Hill in New South Wales down 43% or 46%. Red Hill in the Mornington Peninsula in Victoria down 31%. These
it's
are
like
big
a
falls.
mining town after the boom.
Now, the implications of this are, of course, that people have negative equity.
Yes.
They want to keep the roof over their heads. So what are they going to do? They're going to focus on the debt and bringing that debt down.
Yeah.
That means
meanwhile, utility costs aren't really coming down that much.
No, that's right. And all other spending goes to the side. Right. We're not going to go on a holiday. We're not going to spend money at JB Hi-Fi and buy that new television or the new fridge. We're just going to stay where we are. And a lot of retailers, for example, the Good Guys, Nick Scali, Beacon Lighting, those sorts of businesses, they were really benefiting from the boom in new house sales and new apartment sales. And they've plunged. New house sales now are down to 17-year lows. They're back to where they were in 2001.
So can I overlay this with the Hayne report on the Royal Commission and our big banks and what it's doing to the financial services sector?
Well, the risk is now, of course, that over the last number of years, and I can't tell you precisely how many years, but we saw business lending usurped by mortgage lending. So where business lending many years ago dominated the books of banks, it's now mortgage lending. So there's a very real risk if further declines in property occur. Not only will consumers just go on strike, and that's what the deleveraging is, credit growth grows at a slower rate than GDP, but what we're also going to see is we're going to see more negative equity, less spending and risk to bank balance sheets. The balance sheets are at risk and then let their funding costs go up. The Aussie dollar drops.
Yeah, but at the moment you're not seeing this coming through on balance sheets at all. If anything, well, they're going down their liabilities. At
precisely the top of the property market, the banks are recording the lowest provisions for bad and doubtful debts.
Yes.
Presumably that's going to only go one way now, and that's up. So, I've always said to you, Ticky, when we've been on the show, that the last 5 years for the banks will look nothing like the next 5, and I think that's true. The Hayne Royal Commission really is just cleaning up something that needed cleaning up in terms of behaviour, but it can't stem the tide.
But that now
in fact, it could make it worse.
It puts a new mortgage brokers aside, and what Hayne's recommending there, that puts a new pressure on the big banks in terms of balancing customer service, relationship with their employees and duty to shareholders. I mean, I thought, for example, Matt Common's CBA result was almost to perfection because it wasn't, brilliantly, fantastically high profits.
No, you play down your profits.
It was just fine.
Steady
and
as she
it
goes.
was very, very profitable, but it was pitched very much with Hayne in mind, I think.
Well, they're all searing from the spotlight being shone on them, and that will continue for some time. What's really interesting about Matt Common's comments were actually during the Royal Commission and talking about mortgage brokers. He actually said he'd studied the Dutch model, which of course is the Hayne recommendation that we get rid of trails and then we get rid of upfront payments.
And that borrowers actually pay.
We make the borrowers pay, user pays. So Matt Common said, he studied the Dutch model, is in favour of the Dutch model, provided there's, and he gave one olive branch, and that was that, provided there's channel neutrality. And that means if you're looking for a mortgage, Ticky, and you go to a mortgage broker, you pay a fee to a mortgage broker, but if you go to a bank branch, you also have to pay a fee there. I can't imagine what the legislation is going to be like to enforce banks to charge the same amount as a mortgage broker and not compete with them on that amount. Of course, he would love, by the way, the Dutch model because it's a free kick to the banks. What was once a cost centre for the banks becomes a revenue stream for them. And I don't think the Labor Party's actually thought that through when they said that they're going to adopt all the recommendations, and they've pulled back on that now and said in principle.
Interesting that Kenneth Hayne presumably should have thought that through as well.
Yeah, so what we've seen in the Netherlands, where this model exists, where users pay...
There's more concentration to the big banks.
Well, they pay about $3,000 to $4,000 for a mortgage, and users pay that. But what we've actually seen is not much of a decline. I think about a 5% decline in mortgage brokers writing mortgages. So there hasn't been much of a change.
Oh, right.
It's actually been fairly stable.
I've talked to others who've said that there is more of a concentration to the bigger banks.
The difference over there, of course, is that your mortgage is tax deductible and the fee you pay to a mortgage broker is tax deductible as well. In the UK, which is the model that the LNP and Scott Morrison are proposing, which is where we get rid of trails but we keep the upfront payments or review them in 3 years' time. That model exists in the UK now.
Is it working?
What's happened over there, it is working, but we do need some legislation around churn or over-servicing, because you can imagine, and it's happening in the UK, brokers will encourage you to switch mortgages because they get another upfront payment.
Right.
So there are pros and cons with both models. I suspect where we end up is somewhere in between. It'll be watered down somewhat, and I think the mortgage broking industry will have to survive. Otherwise, banks like MeBank, which is owned by 26 superannuation funds in Australia, what's their distribution model? Obviously, they could market to the superannuants of all those funds, but they also need mortgage brokers to be able to offer their products in comparison to others. And it's a benefit to the consumer to have mortgage brokers because it's a one-stop shop. You can look across different products.
Roger Montgomery, thank you so much. It was a very interesting convo. Thanks.
Pleasure.
That's all for the show tonight. Monday, I'll be speaking with Woodside CEO Peter Coleman, who's over east with a brand new annual report. Until then, thanks for your company.